risk down on the downside. Okay? So now with the $10,000, we've invested $7,100, and we're risking a total of about $190, still only 2.6%. Okay, so our maximum risk is $190, or 2.6% of our entire investment. This is by buying the stock at 3105 and buying the April 2010 35 put. Now, this isn't exactly your question, Swing, but we get this all the time. A lot of people will ask, well, what is the difference between doing this? This is the same thing as buying the April 35 call, or the out-of-the-money April 35 call. Okay, well, let's take a look at that. I'm going to clear both of those out. I'm going to click View Options. I'm going to go to April. Here's the out-of-the-money April 35 call. Okay, so let's go ahead and select that. I'm going to buy, and I'll just start off with one contract. The current price is 85 cents. Okay? Oh, I'm sorry, the ask price is 95 cents. So essentially, let me do that again. Let me do two contracts. We're just looking at 200 shares and two contracts. If I just buy a call, well, hey, that looks almost the same. I have almost the same risks, don't I? I have $190 total at risk. That's the total I put in the position. Okay, because I bought two call contracts instead of buying 200 shares and two put options. Well, that's interesting. I have the same almost profit and loss chart, don't I? Well, one of the problems here is the fact that the $190 I'm risking is 100% of my total investment. Sure, monetarily I might be risking the same amount, but overall I'm risking 100% of my investment. The problem most investors face is, what did I have? I had $10,000 to invest. The option price is about 95 cents. So what does that mean? How many contracts can I invest? If I have $10,000, of course, and I have $100 and I have a $1 contract, doesn't that mean that I can almost enter 100 contracts? Yeah. Cost basis is $9,500. But what's my risk? My risk is $9,500. I stand to lose the full $9,500. This is the problem that some people step into, Swing, is they over-leverage their position. They enter way too many contracts when trying to use the leverage. Now, in the blueprint, Kurt discusses this. Kurt discusses the correct way to look at using a long call instead of a married put if you wanted to do this. They don't act the same. You can get yourself into a big trap, and you can cause yourself a large problem. Now, another aspect of this is I'm actually going to pull up a document here. Let me go to my desktop here, and I'm going to pull up a document. Whoops. Didn't like that at all, did it? Hold on one second. I apologize for that. Huh. Let me try that again, see if I can pull it up. Nope, I can't do that. Okay, that's interesting enough. All right, so let me go back to Power Options here, and we'll just use that same example. There we go. Okay, I apologize for that. I was going to try to Swing. What I'll do is I'll email you this write-up I did for another customer. But what he was looking at is, let's go back to that standard married position we had on checkpoint. Okay, we were going to be CHKP, 100 shares. And I believe it was 3105 was the close price today. It'll fill in for me naturally. And we were going to do the April 35 put at 490. Okay, so let me just pull that back up. Okay, I'm also going to point you guys to some links in a few minutes that you can see on radioactivetrading.com, some of the blogs that Kurt wrote that describe the difference between long calls versus married puts. Now, what other customers ask, and I think this is what you were technically asking, Swing, is here's my stock, here's my put. The question is, well, why buy the stock at 3105? Why not just buy a long call? Okay, well, buy a long call instead of the stock and keep the long put so I'm protected. Well, now what we're doing is we're entering into what's called a long strangle position, but we're doing it a little bit differently. Typically, a long strangle position is buying an out-of-the-money call and an out-of-the-money put, and as the stock moves up in price, we're expecting a wild swing in the stock price to profit on the upside or on the downside. What we do here is if we try to just substitute the stock for a long call, let me clear that out. Stock's at 3105. We're currently interested in the 35 put, so let's just keep it even and say, Okay, $4 below. Let's use the 27.5 call, the in-the-money call for April, and we'll buy one contract as well. This is almost the same price, about $4.90. Okay, so let me go ahead and hit submit there. I keep the put for protection. I add a long call to this instead of the long stock, and now I have what's called a long strangle position. Now, the trick that happens here is that when I enter into a long strangle, remember initially with the stock at 31.05 and my put price at 4.90, my total cost was 35.95. Assuming I did nothing at expiration, let's first just focus on the blue line here down at the bottom. Assuming I do nothing on the position, my break-even price on the married put position was $35.95. And at the time, I was only risking, we're doing 100 share, one contract of the call, one contract of the put here. On the initial married put, my maximum risk was 90, about 95. So essentially, that's what my married put chart looked like. Okay, trying to do that green line. I apologize it's not straight, but this green line here, that's what the married put position would look like. A maximum risk of about $95 per share. We still have the 35 put. The break even is, kind of drew that wrong, didn't I? Yeah, I drew that a little off. Let me try that one last time. Let's do this. Okay, so here's our maximum risk at 95. We've got our put strike at 35, and it would move up, and our break-even would hit right about there, and we continue to move up. Okay, so that's essentially a squiggly line drawing of our married put profit and loss chart. The comparison of buying the call instead of buying the stock is we actually increase our monetary risk. We now have a risk of $230 or 23.5% on our total position. We only paid $980 to get into this position. You're absolutely right. We paid a lower cost basis to get into this position, this long strangle position. It's leveraged, but we're still risking $230 total. If the stock stays at expiration anywhere between these two prices, between 27.5 and between 35 at expiration, assuming, of course, we do nothing, we'll lose about $230 or 23.5%. As if you've joined us for any of Kurt's presentations, we'll see that, I apologize, you'll see that when you lose, we show the gambler's ruin, the martingale technique. So if I have a 10% loss on a position, I need 11.1% gain to get back to break even. If I lose 25%, I'm going to need 33% to get back to break even. So it's a slippery slope. And risking this much, 24 to 25%, is just too much loss to take on one position. Okay, the married put, in this sense, is a much better way to go. If I could pull up that document, which really, I'll send you the document later on, Swing, that I'm referring to about comparing a married put position traded radioactively to using a long call as a substitute for the long stock, but keeping the long put. It was a trade on Newmont Mining that was done, and I believe the dates were last week when I was looking at this position. For Newmont Mining, we saw the same setup. I had a maximum risk on the married put of only about 4.5%. The monetary maximum risk on the strangle, the long strangle here using the long call was much higher. It was still about 24-25% of the total invested. Now, the other key is that Newmont Mining had actually moved up about 6 or 7% from when I entered both positions. After 7 or 8 days, I could close the married put on Newmont Mining for about a 0.1 or 0.2% gain. The long strangle actually had a 10% loss because whatever I was gaining on the call, I was losing on the put option. A swing, how can it be a strangle if you're long on both positions? There's two strangles. There's a short strangle, which is reverse of this, and there's a long strangle. This is a speculative position, so it's called a strangle. This is a long strangle. If I'm short both options, that's referred to as a short strangle. And if I use the options at the same strike price, let's say I sold a 30 put and a 30 call, that would be a straddle, a short straddle. However, if I'm playing earnings and I'm expecting the stock to move up or down wildly, I might buy the 30 call and buy the 30 put. That would give me a long straddle. Doug, I'm sorry. I'm sorry we didn't get to see you on time. Yes, absolutely. This is going to be archived. Hopefully it'll be up about Tuesday of next week. This is going to be recorded. I am recording it, I should say. It should be up in the archives later next week.